What do we do when our contract has some sort of a performance-based bonus component to it? How do we account for that? You can also think about things like royalties that are based on sales, of the performance of a creative work. We call this variable consideration. When an amount to be received depends on some future event, we can call this an uncertain outcome or an uncertain event. The seller should still include the uncertain amount in the transaction price by estimating it, as long as there's a reasonable likelihood that it will be received and it can be estimated, then the seller should include it in the contract value. A seller estimates variable consideration. GAAP allows us two different methods of determining or estimating how much should be included. One is called the expected value, and that's expected value in the statistical sense, where we look at all the different possibilities. Maybe there's I'm managing an investment fund for my clients, and if I have experienced a 10% return on investment over the month, then I'm going to earn an extra $100,000. If I earn 12% or higher, I'm going to get $500,000. And if I earn less than a 10% return on my investment, I'm not going to get any bonus. What we would do there is multiply each outcome, the dollar amount I would receive, times, let's say I think that there's a 40% chance I'm not going to get a return over 10%. I think there's going to be a 20% chance that I'm going to get a 10% to 11% return, and the remaining percentage is I'm going to have over 12%. So I look at the dollar outcome times the probability of achieving that outcome for each different outcome, and I would sum all of them up. And we'll look at a few examples. So that's one method of estimating how much that variable portion is of the contract. And the other method is just to simply use the most likely amount. And the most likely amount method is typically used when there's only two options. Typically used with when there's two options in the contract. I'm either going to get the bonus or I'm not going to get the bonus. The bonus is 100,000. I think there's a 60% chance I will get it, 40% chance I won't get it. I'm just going to say I'm going to get it and include that full amount. At the end of each period, so I'm estimating the variable consideration. I do think I'm going to earn some of it. At the end of each period, the company records a receivable, such as a bonus receivable, based on this variable portion. And then also the revenue as it's earned over the period while it's being earned. Example 5, TrueTech enters into a contract with ProSport Gaming. ProSport wants TrueTech to put its games on TrueTech's TriNet network. The terms of the contract are: on January 1st, 2027, ProSport pays TrueTech an upfront fee of $300,000 for 6 months of access. Okay, so ProSport is saying, TrueTech, if you will put our ProSport games on your network, we'll give you $300,000 for 6 months. ProSport will also pay a bonus of $180,000 if this is really successful. If the users, TrueTech's users, use the ProSport games for at least 15,000 hours during the 6-month period. So we won't know for sure until the 6-month period ends. The questions in our mind are, do we recognize that $180,000 bonus before the bonus period, we determine whether or not there is going to be a bonus? The answer is yes, we estimate it. Then how do we record it over time? TrueTech estimates a 75% likelihood that it's going to achieve the unit usage target and get and earn the bonus. Part A says use the expected value method to determine the contract amount. Well, we know the fixed portion of the contract is $300,000. And we're going to use the expected value method to determine the variable portion of this contract using the expected value method. So for that, we're going to say there's a 75% chance that we're going to get the entire 180,000. And there is a 25% chance that we're not going to get anything. So the expected value of the variable component is 135,000. And we would estimate the entire contract amount to be equal to 435,000. Next, let's use the most likely amount, and let's look at the entries that would be recorded throughout the transactions that take place. On January 1st, the customer pays TrueTech an upfront fixed fee of $300,000 for 6 months worth of service. TrueTech receives cash of $300,000. Of course, this means that assets increase. The other side of this entry is not going to be revenue. It's not revenue because the company is providing a service evenly over 6 months' time. We are going to increase the liability account deferred revenue. We owe this service to our customers. Now, as time passes, in item 2, prepare the journal entry that will be recorded at the end of each month between January 31st and June 30th. So let's say it's January 31st, the first time we're recording this entry. We're not receiving cash. We provided, so we're going to record this $300,000 evenly over 6 months. And that's what we're doing now at the end of January. Decrease deferred revenue, reduce the liability by 1/6. Allocate the $300,000 across the 6-month period and recognize $50,000 decrease in liabilities and an increase in revenue. But there's another component to this, so I'm going to leave a line. Part of our revenue is going to be this $50,000. And another part of the revenue is as time passes, remember we have this $135,000 expected amount. Oh, sorry, no, we're not using 135. We're going to use the most likely amount. The most likely amount, there's a 75% chance that we're going to get 180,000. So we're also going to take the 180,000 and allocate that across the 6 months. We think we're going to get the bonus. And that works out to be 30,000 each month. We're not getting the cash. Remember, no cash is going to be received related to the bonus until the end of the 6-month period when we know for sure whether the pro sport games have been used for at least 15,000 hours. So we're going to record this as, we can think of it as accounts receivable, but more specifically, we're going to call this bonus receivable. Again, a current asset, just like accounts receivable, but it's more specific to what it relates to. And we're going to record that as service revenue. Okay, so this entry is going to be recorded. Let me put some, I'm not going to write this entry over multiple times. But let's look at what the T accounts would look like based on everything that's taken place January 1st and then for each of these 6 months. We received cash on January 1st. We recorded deferred revenue, a liability account of $300,000 on January 1st. And then on January 31st, we reduced deferred revenue by $50,000, and we recorded part of that into service revenue. And then we also added on January 31st the bonus receivable. We recorded that together as an increase in service revenue. We would do that again on February 28th, all the way through June 30th. We'd put in a decrease to deferred revenue each period, and then that would bring our deferred revenue balance down to zero. The bonus receivable would be recorded at the end of each month. 30,000. So this brought the balance in our bonus receivable down to 180,000. And service revenue would be recorded at the end of every month through June 30th. 3 says record the journal entry on June 30th, 2027, assuming that TrueTech does earn the bonus. Okay, so then we would collect the cash related to that bonus. And then we would reduce the bonus receivable account. Remember, we've already recorded the revenue, so we don't want to record the revenue again. And once we credit bonus receivable, remember this was our balance, this is our entry, so now we have no balance in bonus receivable, no balance in deferred revenue. Our service revenue would be the 80,000 times 6 times that we recorded the entry, and it would equal our $480,000 of cash that we had recorded. Let's move on to example 6. Rocky Guide Service provides guided 1 through 5 day hiking tours throughout the Rocky Mountains. Wilderness Tours hires Rocky to lead various tours. Rocky receives $1,000 per tour day. And shortly after the end of each month, Rocky learns whether or not it will receive the $100 bonus per tour day it guided during the previous month if service during the month received an average evaluation of excellent. Okay, so Rocky won't know if he gets the bonus until the month is complete. And it will be based on earning an average excellent review. The $1,000 per day and any bonus are paid in one lump payment shortly after the end of the month. On July 1st, based on prior experience, Rocky estimates that there will be a 30% chance that we'll earn the bonus for July. It guided a total of 10 days from July 1st through July 15th. Before I go into the next few bullet points, I'll look at what's required here. And the first item is prepare Rocky's July 15th journal entry to record the revenue for the tours given July 1st through July 15th. Okay, we need to know what do we do with the estimated likelihood of 30% that it will earn the bonus. And it says here, Rocky bases the estimate of variable consideration on the most likely amount. So if it's a 30% chance, the expected amount, the most likely amount is 0. So July 15th entry is 0 bonus, but we are going to record the fact that Rocky did provide tours and did earn $1,000 per day. Total of 10 days from July 1st through July 15th. I'm going to say plus 0 because he's not expecting to get the bonus. Okay, so when I record this entry, assets increase and revenue increases. Next, in item 2, prepare Rocky's July 31st entry. So let's go up to the second bullet point. On July 16th, based on Rocky's view that now he changes his mind, now he thinks he did provide excellent service during July 1st through 16th. He's feeling much more confident. He revises his estimate to an 80% chance that he's going to earn the bonus for the whole month of July. And he also guided customers for 15 days. So we're on July 31st. We're going to record an entry for a couple things. One is he expects to collect for the days he's worked $1,000 per day times the additional 15 days that he gave tours between July 16th and July 31st. And now he thinks he's going to get the bonus. So let's increase the account bonus receivable, because he's not going to get the cash related to this until shortly into the month of August. He thinks he's going to get $100 per day times, he's feeling very optimistic, times all of the days that he's provided hikes. So that's the 10 plus the 15, a total of 25 days. And he records this as service revenue. Okay, so accounts receivable increases our assets. Bonus receivable also increases the assets. And an increase to revenue is going to be reported on the income statement. Okay, item 3, prepare Rocky's August 5th journal entry. What happens on August 5th? I need to come up to this third bullet point. On August 5th, Rocky learned it did not receive the average rating. So it would not receive any bonus for July, but it did receive all the payment due for the July tours. Okay, so we want to decrease accounts receivable. We're going to credit accounts receivable. The other side of the entry is not going to be anything to revenue. We are going to debit cash. Let's take the two components separate. One will be simply just we got the cash. We take off the accounts receivable that we had recorded on July 31st here and on July 15th there. And I'm going to record a separate entry. I could have combined it as one, but a separate entry on August 5th to undo the bonus receivable. So I'm going to need to credit to reduce the bonus receivable down to 0. And I'm going to need to debit service revenue for $2,500, because when he was confident on July 31st, part of this service revenue, $15,000 was just those daily tours, but the $2,500 was the estimate of the bonus, or his expectation, I should say, expectation of the bonus. And he didn't get it. So let's debit to reduce service revenue, just the portion related to the bonus. And let's credit to reduce the bonus receivable. Okay, so what happened here in our entries? When we got the cash, our assets went up. But when we decreased our receivable, the assets went down, so they were net flat. We decreased revenue for the portion that relates to the performance bonus, and we decreased assets related to our expectation that we were going to receive that bonus. One more short example in example 7. Sula Consultants provided Brand Construction with assistance in implementing its cost savings initiatives. The contract specifies that it will receive a flat fee of $50,000 and an additional $20,000 if Brand reaches a pre-specified target amount of cost savings. Sula estimates that there will be a 20% chance that Brand will achieve the cost savings target. Assuming Sula uses the expected value of the variable consideration, calculate the transaction price. Okay, so we have the flat fee of $50,000 plus the variable portion. And that variable portion here is equal to $20,000 times a 20% chance, and an 80% chance, nothing. So an expected variable consideration of 4,000, a total contract amount of 54,000. Two, assuming Sula uses the most likely value of its estimate of variable consideration, calculate the transaction price. 50,000 plus 0. 80% chance it will not achieve the target for total transaction price of 50,000. And 3, assume Sula uses the expected value of its estimate of variable consideration, but is very uncertain. It has a lack of experience. It doesn't know how to come up with these amounts. Calculate the transaction price. So it's going to be just 50,000. The accounting rules say that if it's very uncertain, don't record any variable consideration.